Hello, welcome back to Global Weltrade Synthetics Provider channel. If this is your first time of visiting this YouTube channel, do your best to subscribe and turn on the notification so you get notified each time I upload a new content. Try to like and refer this channel to your network so that YouTube pushes to a very high level of audience. It's been a long time I upload new content because I got to look at what traders are facing and find the perfect solution to those problems. And right here, the topic we're going to discuss is about dependency problem in Forex synthetic market. So this topic is crucial because when you are analyzing market, what comes to your mind is to follow the path of least action, but in the pursuit to follow the path of least action, a lot of traders invariably, about 90%, follow the path of like they actually follow the wrong path, like they actually lose their money. So this video is gonna help you to understand what it means, what it takes to follow the path of least action. Okay. You see, the forex market is a kind of a plot of price movement against the time variable. You see, when price is moving, a lot of geometrical trajectories get it left for you as a trader to understand those trajectories and how to interpret them. Okay, take for instance, we have the time axis and this is the price axis. Okay, I'll be using line charts because of time. I don't want to be drawing candlesticks. So if you have an arbitrary price movement, this is a kind of price movement. Okay, some people will always be like, whenever price comes to this turning point, it's gonna reverse and go up because they notice such thing at certain time, okay, in the past, like previously. Okay, now you will be like, if the market drop to this level, it's going to reverse. Okay, but in most cases, 90% of the time, that is not true. The continuity and the reversibility problems is like there are major issues here. Most time you want to follow a particular direction, but that direction will reverse. Or most time you want to reverse a particular direction, but that direction will continue. So you guys to learn how this thing operates. Okay. What I will do is I need to jump into the practical part of this video because talking about this in theory doesn't actually provide solution. You just learn surface, but you can't be able to apply it and make money. So I'm gonna do this video on the MT5. Okay, right here I wanna go into practical part of this video. I'm gonna open let's start with a very volatile asset, SFS Bull 18 index. We're gonna start with SFS Bull 18 index. Okay, right here what I'm gonna show you is crucial, so you're gonna pay attention to this. You see, I'm gonna use couple assets So after this asset, I'm gonna check other assets as well, like Philip Indices. And then you rotate the screen. Now you see, like when you study the market, you wanna study the market at structural level. You wanna do structural analysis, right? By looking at various turning points at different time frames, especially the current time frame that you wanna finalize your direction. Okay, like you wanna know the main direction of the market. So this is analysis time frame, like this is 4-hour time frame. Daily, weekly should also be included, but I don't want to check all the time frame, so I have to be on the 4-hour because it's a generalized higher time frame that can be used to get the true nature of the market, but you can use the daily as well. Okay, so some people will be like, this is a strong resistance, so whenever this market move from here to here, it will reverse. Okay, let's take for instance that it's touch here and drop, but that is a wrong belief, because this is not a drop, this is just a retracement because of this impulsive breakout. So this is a retracement and this is continuation. So it's better to understand market as a cyclic event than to understand the market as a reversible or continuous event, you know, within a given boundary, like resistance and support. So you see the behavior: impulse, retracement, impulse, equal high, retracement, impulse, breakout, new high, retracement, and then another impulse, new high, retracement. You see, when your psychology is corrupt, you could misunderstood retracement as if it is a change of trend. Okay, so in essence, what I'm trying to say here is that when I get a equidistance channel, I feel like this is a constant path, meaning that a path whose direction never change or the slope has not changed, even if there are minor slope changes, like internal slope changes might happen, but the overall slope changes positive, like I'm sorry, is constant, meaning on the overall level, on the long-term view, the slope does not change. And how do we analyze the slope of the market? You just consider fixing that market in a channel and finding the angle subtended by that channel with respect to the horizontal. If the tangent of that angle is positive, then the slope is positive and the direction is upward. So we can say this market is an uptrend market. So you're trying to sell this market at this resistance is waste of time. It's not going to sell. Yes, there will be some reaction, but those reactions are not due to the resistance. They're actually due to the inherent or underlying characteristics of that part. So the topic we are discussing right here, we're talking about path dependency problem in Forex synthetic market. And at this junction, I'm gonna say this: every path does not depend on each other. Like every path is independent of each other. There are major two parts in the market: the uptrend and downtrend. They are independent. Don't think that because here is a strong resistance, that when this part reach here is going to hit another sell part. That is a kind of let's call it an assumption. In trading, assumption does not hold. When you assume things in the market, you wanna induce a force. Then you inducing a force in the market is not realistic, because you are not the one that will determine the direction. Is the market maker. So you're trying to induce your own personal belief, your own personal assumption. It doesn't work. So the best thing that will work is to follow the rhythm of the market, to understand the mechanism of the market, the dynamics of the market, okay, the market structure, and the power of a part, the consistency of a part. Every part is consistent. Every part remain constant in direction until market maker decide to change it, not by the virtue of boundaries like resistance and support. No, even anyone that teach you that is a fake tutor, that fake gurus, they are telling you on the resistance the market will reverse. Absolutely, that's wrong. And they will tell you on the support the market will reverse. Absolutely, those things are wrong. They are never true. Okay, they are never true, bro. And so you guys to learn this, gentlemen, and yeah, everyone should learn this. Okay, I'm a bit stressed about this content, but I feel like I'm making a point here. Like I'm trying to talk something reasonable here. By the time I touch some other asset, it becomes clearer that every part is independent of another part. Like I'm gonna give some example. For instance, let's shift to the daily time frame. Let's shift to the daily time frame. Okay, so we have this part. Okay, this part was an uptrend part. That was a strong that was a strong resistance here. So this is a strong resistance. Yes, because why it is a strong resistance? Because when price reach there, it creates a sell path, like a downtrend that actually creates a new low. If you check over, it actually breaks this low a little bit. You will see some repos at certain lower time frame below that red line. You will see a lot of repos. Okay, so it actually breaks that low. So let's go back to the daily time frame. You break that low, and so it's a valid resistance. At least it created an action that break major lows, that break minor lows and still break major lows. Like the market actually reversed there with high volume. As simple as that. The market reversed there with high volume because the parts break a new low. Now, as an assumption trader or somebody that wants to depend on the previous part, you'll be like whenever the market reacts to this resistance, you're gonna reverse. Once price hit here, you're gonna place as much sell as you can. You cannot fool the market makers or liquidity provider or people that want to control buyers and sellers so that the profitability and the losses is going to be optimized. Like the market will not lose balance. Everything will be will be at the right state in time. And so right here, when price hit here, you start selling. You'll be like, oh, you are taking out, let's place more sell, and you sold, and then you make some profit. You feel like you want to hold long term because you really want to take profit here. The market break, and you could have lost all your money doing something. The more you add position, you keep losing. Okay, I'll be like, let's add more position, you're gonna make more. But that's not true. That's not true because you're gonna lose more. So I'll be ending this video. Try to be proactive with us, enroll for our courses, and subscribe to our VIP signals so I become successful in this kind of shit. Bye for now.